Well, the Dow Jones Industrial Average rallied to its third best point gain in history as stocks rejoiced at the possibility of better trade relations with China and South Korea. Future deals that would enforce joint ventures and curb theft of trade secrets that could be worth billions of dollars to American businesses, while actually also giving us greater access to 1.3 billion people. Technology, that was the best performing sector. Even Facebook was able to climb off the canvas into the plus column right at the end by the closing bell. Financials rebounded with Comerica and KeyBank, the biggest winners there. And then consumer discretionary names popped, led by Lowe's, which went higher. The CEO called it quits and the stock exploded. That's not always a good sign for the CEO. And of course, it was another strong session for Netflix. Now, last Friday, the Dow Jones Industrial Average, it did fail at a key support point, but the more widely used and followed S&P 500 actually held. In fact, it formed a perfect double bottom, which is the most bullish of all chart formations. Now, your key resistance points on the upside, folks, for the S&P 500, 2790, NASDAQ, 7430, and for the Dow, 24730. Right now, we're talking, though, about regaining swagger. Now, the question is, individual investors, can they sort of regain their bullish swagger? According to the American Association for Individual Investors, bullishness dropped almost 4 percentage points to 33%, which is well below the historic norm of 38.5 and really a million miles below the January 4th high. We almost hit 60% bullishness at the start of the year. Now, I continue to say, please don't get whipsawed out of these markets, but it's obvious that the wild swings and all the doom and gloom is taking a toll on investors. In fact, investors yanked over $24 billion from ETFs just 1 week after plowing in more than $44 billion. Almost $28 billion were in U.S. equities. They did put money into international equities and a lot of money, $1.6 billion, into fixed income. So the big question right now is the message of the market. The light volume today underscores that there remains a high level of anxiety over two things that I think are going to be fine: the so-called trade war and negotiations and the Federal Reserve and possibly 4 rate hikes. Listen, the economy looks amazing, and stocks have actually gotten cheap on a historic basis. In fact, to be quite honest with you, if it wasn't for all these headlines, I think they'd be trading their historic highs with respect to certain valuation metrics. So I think you should have overexposure right now to industrial names and technology names. I'm fine-tuning a special report, by the way, on Spotify. I should have it ready tomorrow or the next day. Make sure you get a free copy. And, of course, go to my site for everyday commentary, wstreet.com.